$397.4 billion. That is a sum so vast it challenges the human imagination. This is not just a successful quarterly report or a healthy balance sheet. It is the largest cash pile in corporate history. For decades, this mountain of capital was controlled by the most famous investor the world has ever known. But as the sun rose over Omaha, Nebraska on January 1st, 2026, the era of Warren Buffett officially came to an end. The keys to this $397 billion war chest have been handed to a new leader. His name is Greg Abel. The world is not just watching, it is holding its breath. The transition of power at Berkshire Hathaway is perhaps the most significant corporate handover of the 21st century. It marks the precise moment when a personality-driven mythology transforms into a system-driven corporate operation. Omaha has always been a quiet city, but on this particular New Year's Day, the silence felt heavier. For 60 years, the financial world looked to a modest office building in this Midwestern town for wisdom and stability. Now, there is a symbolic empty chair at the head of the boardroom table. The psychological shift is profound. For millions of investors around the globe, Warren Buffett was more than a chief executive officer. He was a grandfather figure, a sage, and a symbol of American capitalism at its most rational. Replacing such a figure is, by any standard, an impossible task. Yet, the work of the empire does not stop for nostalgia. Greg Abel has stepped into the vacuum left by a giant, and he does so at a time when the stakes have never been higher. To understand the weight on Greg Abel's shoulders, one must first understand the scale of the empire he now commands. Berkshire Hathaway is a conglomerate that defies modern corporate logic. It is a $1 trillion machine with a reach that extends into almost every corner of the global economy. It owns GEICO, one of the largest insurance providers in the world. It owns the Burlington Northern Santa Fe Railway, which carries the lifeblood of American commerce across thousands of miles of track. It owns massive energy utilities that power millions of homes and businesses. Beyond these wholly owned subsidiaries, it holds massive stakes in iconic brands like Apple, Coca-Cola, and American Express. It is a diverse and complex web of businesses that generates billions of dollars in profit every single month. Managing this scale requires more than just intelligence. It requires a specific kind of temperament. Greg Abel is not Warren Buffett, and he is the first person to admit it. While Buffett was known for his witty aphorisms, his public television appearances, and his ability to explain complex financial concepts through simple stories, Abel is different. He is often described as a disciplined, rational, and low-charisma executioner. He is a man of spreadsheets and operational efficiency. Where Buffett was a philosopher of capital, Abel is a master of the machine. He has spent years quietly running the non-insurance operations of the company, proving his worth through results rather than rhetoric. He does not seek the spotlight, and he does not attempt to mimic the charming persona of his predecessor. This lack of charisma is not a weakness, it is a calculated trait. In the post-Buffett era, Berkshire does not need another oracle. It needs a disciplined pilot who can navigate the largest ship in the financial ocean without crashing it into the rocks. Before we continue, subscribe to the channel and tell us in the comments where you are watching from. The central question haunting the halls of the headquarters in Omaha is whether a system built by a singular genius can function when that genius is no longer in the room. History is littered with the carcasses of great companies that withered away once their founders departed. The fear among institutional investors is that the magic of Berkshire was tied to the man, not the model. They worry that without the unique intuition and the unparalleled reputation of the founder, the company will lose its edge. Can Greg Abel maintain the culture of decentralized management? Can he resist the urge to overmanage the talented individuals who run the various subsidiaries? Most importantly, can he make the difficult decisions about where to move hundreds of billions of dollars when the market turns volatile? This tension between the old world and the new world is the primary challenge of the transition. The initial hours of the post-Buffett era were marked by a surprising lack of drama. Many analysts had predicted that the day of the formal transition would trigger a massive sell-off as nervous investors scrambled for the exits. They expected a period of intense volatility and a public crisis of confidence. Instead, the market reacted with a quiet, almost respectful stability. The share price of Berkshire Hathaway Class B stock moved within a narrow range, showing that the transition had been priced in for years. This silent handoff is a testament to the meticulous planning that Buffett and his late partner Charlie Munger put into place over a decade ago. They did not leave the future to chance. They spent years grooming Abel, introducing him to shareholders, and slowly shifting responsibilities to his desk. By the time the calendar turned to 2026, the market already knew Greg Abel. However, the lack of immediate panic does not mean the danger has passed. The $397 billion sitting in short-term treasury bills is a constant reminder of the unfinished business left behind. This is not just a rainy day fund or a sign of success. In many ways, it is a warning. It is a signal that even the greatest investor in history could not find enough attractive places to put money to work in recent years. It is a loaded gun, and now, Greg Abel is the one with his finger on the trigger. The pressure to deploy that capital will be immense. Every quarter that the cash pile grows, the voices of critics will grow louder, demanding that the new leader prove his worth by making a massive acquisition or returning the money to shareholders. This massive reserve of liquidity creates a unique paradox. It provides Berkshire with unparalleled safety in a crisis, but it also creates a drag on performance during bull markets. For Greg Abel, the challenge is not just keeping the lights on at the railway or ensuring the insurance premiums are calculated correctly. His true test will be how he uses the $397 billion to define the next chapter of the company. Is this cash a shield to protect the empire, or is it the ammunition for a predatory strike that will reshape the corporate landscape? As the first weeks of his leadership unfold, the financial world is watching for any hint of a move. The man who does not seek the spotlight is now standing directly under its brightest beam, and the weight of nearly $400 billion is pressing down on every decision he makes. To understand the scale of the challenge Greg Abel faces, one must look at the recent actions of the firm under the final years of Warren Buffett's active management. Between 2023 and the start of 2026, Berkshire Hathaway engaged in what can only be described as a systematic liquidation of massive portions of its equity portfolio. Over this period, the company offloaded a staggering $239 billion in stocks. This was not a sudden panic or a desperate search for liquidity. It was a deliberate, cold-blooded exit from the markets by a team that believed the prices had become detached from reality. For 14 consecutive quarters, Berkshire remained a net seller, meaning it consistently sold more stock than it purchased. This prolonged selling streak signaled a profound lack of confidence in the prevailing prices of the public markets. For many observers, this was the ultimate vote of no confidence in the global economy by the most famous value investor in history, and it has left Greg Abel standing on a mountain of cash that the world is waiting for him to use. The reasoning behind this massive retreat becomes clear when examining the fundamental indicators that the Omaha office has always prioritized. The famous Buffett indicator, which compares the total market capitalization of all publicly traded stocks to the gross domestic product of the United States, climbed to an alarming 226.8%. This was significantly higher than the levels seen during the height of the dot-com bubble or the months preceding the great financial crisis of 2008. Furthermore, the Shiller price-to-earnings ratio, a metric that adjusts for inflation and looks at average corporate earnings over a rolling 10-year period, soared above 41. To put that in perspective, the historical average for this metric is roughly 17. These were not just numbers on a spreadsheet, they were sirens screaming that the market had become dangerously expensive. By choosing to hold cash rather than participate in what appeared to be an overvalued frenzy, the leadership at Berkshire sent a clear message that patience is more valuable than participation when the price of entry is too high. Instead of chasing the latest technology trends or bidding for expensive companies at the top of the cycle, Greg Abel and his team chose to park their capital in short-term United States Treasury bills. By the dawn of 2026, the company had become one of the largest holders of government debt in the world, often surpassing the holdings of major sovereign nations. This strategy allowed Berkshire to earn a steady, risk-free return while waiting for the inevitable correction that follows every period of market excess. However, for Greg Abel, This strategy is a double-edged sword. While the cash provides a shield against economic downturns, it also creates an immense psychological and professional pressure. He is now the man holding what Buffett often called a loaded gun. The financial world is waiting with bated breath to see when and where he will fire it. In a cooling economy, the opportunities to buy great businesses at fair prices might finally emerge, but the window for execution will be narrow, and the scrutiny from the public will be intense. While the focus of the public is often on the massive cash pile, the underlying engine of Berkshire Hathaway continues to hum with remarkable efficiency. In the first quarter of the transition year, the company reported operating earnings of $11.35 billion. This figure represents the actual profit generated by the companies Berkshire owns outright, ranging from the massive BNSF Railway to the energy plants and insurance giants. This robust performance demonstrates that the system Greg Abel inherited is not just a pile of money, but a collection of high-quality assets that produce consistent cash flow regardless of market volatility. The strength of these operations gives Abel a cushion that few other corporate leaders enjoy. He does not need to gamble with the $397 billion because the core businesses are already providing the company with an incredibly strong foundation for growth. Despite this operational strength, a cloud of skepticism hangs over Greg Abel's leadership among institutional investors. Large hedge funds and pension managers are openly questioning whether Berkshire Hathaway has grown too large to succeed in the long term. The primary concern is the search for what the company calls elephants. These are massive acquisitions worth tens of billions of dollars that are large enough to move the needle for a trillion-dollar conglomerate. In a saturated and highly competitive market, finding such opportunities is becoming increasingly difficult. Private equity firms and sovereign wealth funds are now competing for the same deals, often driving prices to levels that Greg Abel's disciplined approach cannot justify. The fear among skeptics is that Abel might be forced to settle for mediocre deals just to put the cash to work. Or worse, that he will remain paralyzed by the fear of making a mistake, allowing the cash to lose its purchasing power to inflation over time. At the current market price of the Class B shares, known by the ticker symbol BRKB, investors are weighing the stock price against the intrinsic value of its assets and its $327 billion stock portfolio. There is a growing debate about whether the market is fully accounting for the risks of the transition, or if the discount applied to Berkshire shares is an opportunity. For Abel, this valuation gap is a constant metric of his success. He must prove to the world that the company is worth more than the sum of its parts, even without the legendary name of Warren Buffett at the helm. This leads to the most pressing question facing the global financial community as the 2026 transition continues. Why is the most successful investment firm in history sitting on nearly $400 billion while the rest of the world continues to buy? What does the leadership in Omaha see in the data that everyone else is choosing to ignore? The answer to that question will define the first 5 years of the Greg Abel era and determine if this massive cash pile is a sign of wisdom or a missed opportunity. The shadow cast by Warren Buffett is long, stretching across decades of market history and into the very DNA of global finance. To follow such a figure is to invite immediate and relentless comparison, a challenge often referred to as the successor's curse. History is littered with examples of organizations that struggled to find their footing after a visionary founder stepped away. When Steve Jobs passed the torch to Tim Cook at Apple, the initial reaction was one of profound doubt. Critics argued that a supply chain expert could never replicate the creative spark of a man who changed the world with a single product launch. Similarly, the transition at Microsoft from Bill Gates to Steve Ballmer led to a period of stagnation where the company lost its dominance in mobile and search. Greg Abel now stands at this exact historical crossroads, facing the same skepticism that met every major corporate successor in the last 50 years. The question is not whether Abel can be the next Buffett, but whether he can survive the comparison long enough to define himself. There is a fascinating theory in corporate governance known as the Nadella inversion. It suggests that the most successful successors are often those who least resemble the founder in personality and style. While the founder is often a charismatic leader who builds through sheer force of personality, the successful successor is typically a disciplined operator who focuses on systems, culture, and scale. Satya Nadella did not try to be the public face of technical genius that Gates was. Instead, he transformed Microsoft into a cloud-first utility that eventually became more valuable than it ever was under its founder. Greg Abel embodies this inversion perfectly. He does not provide the world with witty aphorisms or folk wisdom. He is a man of spreadsheets, regulatory filings, and operational efficiency. By leaning into his role as a rational executioner rather than a market sage, Abel may actually be better positioned to manage the $397 billion cash pile than a more creative investor might be. This shift from personality to system is the true test of Warren Buffett's life work. For 60 years, the world viewed Berkshire Hathaway as an extension of one man's brain. However, the internal reality is that Buffett's greatest achievement was not a specific trade in Coca-Cola or Apple, but the construction of a corporate architecture designed to function without him. He created a decentralized empire where subsidiary managers are given total autonomy, provided they send their excess cash to the head office in Omaha. This system ensures that the individual genius of the founder is less important than the collective discipline of the structure. Greg Abel's primary job is to be the guardian of this architecture. If the system survives the absence of the personality, it will prove that Berkshire is not just a mutual fund with a famous manager, but a permanent institution of American capitalism. For investors holding Berkshire Class B shares, known by the ticker BRKB, the strategic implications of this transition are profound. The coming years will likely be characterized by higher-than-usual volatility as the market adjusts to a post-Buffett world. Practical advice for shareholders often centers on patience. Historically, Berkshire has traded at a discount during times of leadership uncertainty, which can provide an opportunity for long-term holders to increase their positions. However, for those seeking the explosive returns of the 1980s and 90s, the reality is that the company's massive size now makes such growth nearly impossible. Investors should view their holding not as a speculative bet, but as a defensive fortress. The $397 billion in cash acts as a massive insurance policy for the entire portfolio. In a world of overvalued technology stocks and geopolitical instability, holding a company that is essentially the lender of last resort for corporate America is a strategy that prioritizes the preservation of capital over the pursuit of quick gains. Looking ahead to the next 5 years, the landscape for Berkshire Hathaway under Greg Abel will likely move in one of two directions. The first possibility is that the company becomes a massive, utility-like giant. In this scenario, the cash is slowly returned to shareholders through aggressive buybacks, or perhaps even the first dividend in the history of the company. This would satisfy institutional investors who are tired of seeing the cash sit idle in treasury bills. The second, more aggressive possibility is that Abel waits for a significant market correction to act as a predatory buyer. With nearly $400 billion at his disposal, he could theoretically acquire several Fortune 500 companies in a single month if a panic occurs. This would transform Berkshire from a passive observer of the market into the dominant force of the next economic cycle. Whether Abel chooses the path of the steady utility or the patient predator will be the defining story of the late 2020s. Ultimately, the final philosophy of the transition rests on the truth that great companies only survive their founders when the system survives the personality. The mythology of the lone genius is a powerful narrative, but it is a dangerous way to run a global conglomerate. By institutionalizing the principles of value investing and operational discipline, Buffett has given Abel a map, but he has not given him a destination. The definitive image of this historical handoff took place in a quiet moment in Omaha, where Buffett sat in the audience, no longer the man at the microphone, while Greg Abel stood at the podium to address the shareholders. It was a visual representation of the passing of an era. The legendary founder was finally letting go, trusting that the machine he built was strong enough to run without his hand on the lever. As the sun sets on the age of the superstar investor, the world is left with a haunting reminder of the stakes involved. The $397 billion sitting in the Berkshire vaults is more than just a number on a balance sheet. It is the accumulated labor and savings of millions of individuals who trusted a man in Omaha with their financial futures. It is ammunition for the next era of global finance, a massive reservoir of liquidity waiting for the right moment to be released. Greg Abel may not have the charisma of his predecessor, but he has something far more valuable in a crisis. He has the power to decide who survives the next market crash. The era of the oracle has ended, and the era of the operator has begun. The market is watching, the cash is ready, and the first 5 years of this new empire will decide if the legend of Berkshire Hathaway was the product of a single man or the triumph of a perfect system.